Hello and welcome to the Value Exchange. I'm Jack Newrider, a research analyst for Fidelity Digital Assets. I'm joined by a man that needs no introduction, Jurrien Timmer, Director of Global Macro for Fidelity Investments. Jurrien, let's jump into it. You cover global macro, and I think it was maybe 2 years ago you got interested in Bitcoin, the digital asset space. Originally, what was it that sort of drew you towards it? And I've noticed as of late, it's more of a topic of conversation. It's grown in size over the past few years. You've sort of dedicated more time and thought to it. How did that come about?
As a global macro person, especially one who's in the public eye a lot at Fidelity, I was a spectator for a long time on Bitcoin and the digital asset space, and then it started to run, and then I felt, I really need to have an opinion on this because people are going to ask me. And as you know, for Bitcoin, you can't just have a casual opinion, right? You have to go really deep down the rabbit hole, spend, maybe a couple hundred hours to understand it. And so there was no quick way to do it, so I just kind of went deep and came up, with a thesis, kind of used some of the stuff that was already out there, on the demand side, on the supply side. But that's how it started. I just figured I needed to have some sort of informed opinion being in the role that I am. And of course, just on a personal basis, I was just interested. Whenever something goes up a lot, you become interested, right?
Yeah, of course. And the subject of many media headlines for sure, still to this day. So when we look at, when you initially looked at Bitcoin and digital assets, there's no cash flows. It's this interesting, asset that sometimes gets labeled a Ponzi because it has no cash flows, it has no industrial use case. How did you originally think about comparing the opportunity cost of an allocation to Bitcoin in a portfolio relative to something that you can traditionally value? And then maybe how did that evolve through to today?
Yeah, so certainly it's a limitation when aspiring money, maybe we can call it that, if there's no interest rate or no cash flow, you can't plug it into a DCF model, a discounted cash flow model, which is where you put in earnings in the numerator, an interest rate in the denominator, and so there are no cash flows to discount, so you can't have a discounted cash flow. But then again, neither does gold, right? And the way I looked at it at the beginning was to compare it to gold. Where would it go in a portfolio if Bitcoin ends up being a proven store of value? It's still trying to prove itself. I don't think it has quite done it yet. But I compared it to gold because gold has no cash flow, but gold's been around for thousands of years. It's a recognized and widely accepted store of value. It's also money. It can be used as money. It used to be money. But that's kind of how I took the approach. And there's a way to value gold. It's just not using a traditional cash flow method.
Certainly. So then when you think of a monetary asset and we say it's an aspiring monetary asset, it's certainly very volatile from an asset price perspective, but the network itself has certain characteristics like a predetermined supply schedule where we know, if you own one Bitcoin, it's one of roughly 19 million Bitcoin today and one of 21 million that will ever exist, through time, at least in theory. And so you can start to pull apart potentially a supply curve and a demand curve. And I think Plan B was sort of one of the original. I think Saifedean Ammous even alluded to stock to flow and gold analogies throughout the Bitcoin standard. And I think that's sort of the jumping off point. In 2018, 2019, Plan B's stock to flow model became popular. You sort of wrote about it a lot, and we featured it in the paper as well, as it's a monetary asset. Let's look at its supply and demand curves together. And so maybe we start with stock to flow. When you pick that apart and analyze it, what do you see that is positive about it and maybe negative about it, and where do you sort of sit on the usefulness of something like stock to flow?
It's pretty much the first thing I did. Was you scour the internet, you look for work that's been done, not to steal it, but just to learn from it, right? And so I found the stock to flow model. Plan B has been very transparent about publishing it. I've talked to him a few times, and it was certainly a really interesting way to get the ball rolling. But I did find quickly that there were limitations, right? So you look at the stock to flow model, it's this stair step thing that goes essentially to infinity, and that seems a little bit unrealistic. And I recently did sort of a revision of my interpretation of stock to flow. And the premise, of course, as you mentioned, is there's a limited supply, and the more supply has been created and the less there is left to be created, the higher the stock to flow becomes, because it will take more and more years to replace the existing stock. And so that's the basic premise. But where the stock to flow model kind of falls short is that, my sense is at least, that as you get closer to the ultimate supply cap of 21 million, and like you said, we're about 19 or so right now, each incremental halving every 4 years, where the reward for mining Bitcoin gets cut in half, to me, as you get further along, each halving probably will have less and less of an impact, just because you're talking about fewer incremental coins relative to a larger base. And so what I recently did is I kind of added a second independent variable to the stock to flow, which is the how close to the limit you are in terms of the overall supply.
Accounting for the diminishing
yes,
rate.
and so that's an asymptotic curve that kind of drags down the later values of the stock to flow model. So it's, to its credit, the model has done a great job explaining the price action, and certainly in the early days, the numbers were such that it made sense that it would explain it that way. But I think as you get further along, the incremental price gains are probably less explained by the supply curve and probably more by the demand curve, which is the overall adoption of the network.
Right, so I think that's a great transition. If you take just scarcity as the only factor, which is really what the stock to flow model is doing, I think it's maybe incomplete, right? I could copy Bitcoin and create the exact same thing and make it have a higher stock to flow ratio, but if there's nobody that's actually valuing it, it's not secure and it's completely centralized, I'm not actually offering anything that's interesting, and the demand curve would be one, it would be me, right? And so how do you think about the demand curve? And then you talk a lot about technological demand curves and how Bitcoin's demand curve looks very similar.
Yeah, and just another way to put the supply limitation is that if something has no value, it doesn't matter how scarce it is, right? So you need to get to the value part, which is the network, right? And that's we call it Metcalfe's law, which basically says that the value of the network grows exponentially as the network itself grows. And we have many examples of this. I've looked at a lot of history, at historical S-curves, so these exponential growth curves, and you can go all the way back, a couple of centuries to the railroad network, to cell phone adoption, to the internet adoption itself, numbers of TVs in households. There's lots and lots of examples of S-curves, and they all start, really, really steep, and then they become asymptotic, still growing. But eventually everyone has a TV, or everyone has a mobile phone, or everyone has internet access. So there's a limit to how far you can go. And what I found is that these S-curves, almost regardless of whichever you use, over the first 10 or 12 years of Bitcoin's history, it showed the exact same story as the supply, as the stock to flow model has. So a steeply rising curve that starts to flatten out over time. And I do think we're at that point where it's still growing, but not at the rate of change that it was, 5 years ago or 10 years ago. And so, but Bitcoin is probably the most unique aspiring asset class I've ever seen, because how many other asset classes do you know where you have that supply curve, where you have that limit, that hard cap of the supply? Like even gold doesn't have that. Gold supply grows about 1% a year, and you can always find more gold. It's just it gets more expensive, the higher the price goes. But for Bitcoin, you have that hard cap, while at the same time you have an exponentially growing adoption curve. And I don't know of any assets that combine those two. I think it makes it trickier to value, right? If it was just like gold, then you would value it just like gold. But there's this other dimension going on that makes it look or act like a venture asset, because you are in that growing adoption phase, and that's why Bitcoin has been so volatile, of course, and I do think that's kind of a permanent feature. Maybe not as volatile in the future as it has been in the past. But for me, it's all a question of what is the slope of that curve, right? Because you can come up with almost identical S-curves that just slope a little bit differently, and it could make the difference between an ultimate price of $1 million versus an ultimate price of 100,000. And so I think that's where the nuance comes in, and I think that's for us analysts who are trying to value Bitcoin as we move further. That's going to be the hardest part, is just to measure that adoption curve, and it's just a question of how many people are going to use it and for what.
And it is interesting, right? Because you do know, like if you're just looking from a supply-demand perspective, you know half the equation, right? You already know the supply curve, and then it's, depending on what you want to assume about that information, but then you're really just projecting that adoption rate if you're just going to look from a supply and demand curve perspective. And like you mentioned, I think you typically use cell phones and internet adoption as like a proxy of here's two different outcomes. Bitcoin's current address growth rate, which is just a proxy for network adoption and use of the Bitcoin network, has grown in a similar fashion to these two. But now you're starting to hit a part of the curve where, like if you project the two out through today in 2022 through 2030, you get widely different answers. Yeah. Would you say that's like a bug, like of these models, or is it more like, because I think of like a discounted cash flow model, if you change the terminal growth rate assumption from year 6 onwards, you can make it say whatever you want it to say. So it's almost like it's a different model, so it's easy to say like this isn't valid because you can get so many different answers based on the assumption you're using.
I think it's a feature of the fact that we're dealing with exponential math, right? So these are power curves. So it's one thing if your cash flow is 6% instead of 5%, or if the discount rate is 2 instead of 1. Those are somewhat linear ways of looking at the world. But Bitcoin is exponential, it's nonlinear. So a curve that slopes at x versus x times 2 has an exponential impact on the price. So it's not a question of it's worth 110,000 versus 120,000. It's like 100,000 versus a million. And that's why the slope of the adoption rate going forward, I think, is going to be the driving factor. There's the supply scarcity as well, but it's a known, and as I mentioned earlier, the more coins get mined and the closer you get to that cap, I think the less of a variable that's going to be. It's going to be part of the value proposition of buying it in the first place because of that scarcity. But the incremental difference between this price or that future price is going to ride on the slope of that curve.
Right. So then, if we look at today, the price that some of these models using whatever your given assumptions are would suggest are likely higher than what the price of Bitcoin is today, right? It's $20,000 we're speaking right now, mid-July. Would you say like things like macro variables and interest rates and Fed policy, like those aren't effectively captured there, but those are sort of short-term variables that you really shouldn't be trying to factor in, right? Otherwise you would have 15 variables and you would be really data mining. Would you say just there's sort of beauty and simplicity of just using these supply and demand models to project long-term value accrual to something like Bitcoin?
Yeah, and I've used the example of Apple Computer. Not that I'm an expert on Apple as a stock, but you look at its incredibly powerful network with iPhones and iTunes and iPads and iMacs and its operating system iOS. The more that network grows, the more powerful it becomes. Just the bigger the moat is around the network, the harder it is for competitors to penetrate that network. I can invent an even better iPhone tomorrow. Well, I can't, but like in theory, if I could, that doesn't mean I'm going to take Apple's business model away or its business away. And so, I think Bitcoin is getting to that point where it is big enough. I think there's about 38 million non-zero addresses, and that's growing. It was like 23 million at the 2017 peak. So the curve is growing, the adoption is growing, and if it's really a thing, which I think it is, it's going to do that regardless of macroeconomic conditions, right? People are going to buy iPhones regardless of whether we're in a recession or not. Maybe they buy fewer in a recession, but so I do think the macro variables matter, right? 2 years ago, during the lockdowns, when Bitcoin went from 3,000 on its way to 69,000, we were looking at maybe a very long period of financial repression and very low or negative real rates, lots of fiscal policy, lots of money being printed, M2 going off the charts. So that was a very fertile environment to kind of become a believer in saying, I want sound money because I don't know how sound our fiat money is going to be. That narrative has now changed. I mean, the Fed is tightening aggressively. Maybe it's going to tighten too much. Maybe it then has to start easing after that. But right now, inflation is a huge problem, and the Fed seems to be committed to taming it. And so that's a much less favorable narrative or background than what we had a couple of years ago. But the Bitcoin network continues to grow. The price is not reflecting it, so the valuation is a lot lower than it was. And I look at, I think it's important to look at valuation because price alone doesn't really tell you a lot, right? I mean, a car could be worth, could cost $40,000, but have a lot of value. So you have to look at value. So I look at the price per millions of addresses as kind of a PE for Bitcoin. And even though the price is only back to kind of late 2020 levels, the valuation, the price to network ratio is actually all the way back to the 2013 peak. So you can tell that Bitcoin, because you don't have those macro variables making it a very obvious trade right now, or investment, I should say. Investors are not rewarding its growing network the way they did a few years ago, and so that's another way of thinking about it. But the macro variables, will change. But the dollar is very, very strong. Monetary policy is not quite tight yet, but it's moving there. The fiscal impulse that we got with the CARES Act and the fiscal stimulus, that's all gone away now. I mean, it hasn't been reversed, but on a flow basis, it's not there anymore. So it's almost like fiscal drag. So the narrative, has almost done a 180. And so in that sense, I guess it shouldn't surprise us that Bitcoin has corrected. And then, of course, we've had this idiosyncratic storm of deleveraging going on that has affected the entire digital assets.
Like longer term fundamentals are still largely intact, right? We tend to talk about, for Fidelity Digital Assets research desk, we tend to talk about like extrinsic and intrinsic variables. So things that like the Bitcoin network and the digital asset ecosystem are responsible for or can control. And those are things like, okay, you think about the blockchain trilemma, decentralization, security of these networks, and scalability, and like all of the infrastructure being built around them. And we continue to see all of that sort of mature. So like from a fundamentals perspective, if that's what we want to call it, like fundamentals continue to grow during this period of market sell-off. But the extrinsic variables or factors, you mentioned a lot of them there, have certainly contributed to this sell-off. Where do you see the next 3 to 6 months more broadly? We think about traditional equities and Fed market policy in the face of high CPI, backwards-looking data, but also at the same time potentially a slowing economy going forward. It seems like there are economists on both sides screaming, the Fed is doing too much or the Fed is doing too little and they need to raise to 5% right away. You tend to be sort of a calm voice in the middle that sort of can tell the story of both sides. Where do you view the next 3-6 months of this macro environment evolving into?
Well, the Fed is in a place where it hasn't found itself for many, many years, right? So the Fed has a dual mandate, full employment and price stability. And for the past 10, 15 years since the financial crisis, inflation was chronically under the Fed's target of 2%. And we can argue whether the Fed should ever target positive inflation, but that's a conversation for another day. But the Fed, whenever there was a stress in the system, the Fed could immediately kind of pivot to a more accommodative policy because it didn't really have to worry that inflation was going to run hot as a result of it, that it was going to overstimulate, and then inflation is all of a sudden at 3 or 4. But now, of course, we have a massive inflation problem. The CPI just printed 9.1% year over year, which is the highest since the late 60s, early 70s. And so the Fed at this point has to pay attention to that, and that's why in a normal environment, the economy is starting to weaken. I don't think we're in a recession, but that could happen down the road, of course. But the economy clearly is slowing, and if this was a few years ago, the Fed might already be saying, okay, we'll bring rates up back to neutral, which is around 2.5%, and then we'll take a look. And we're not having that rhetoric at all. The Fed's on its way, presumably, to about 3.5%, and it's about to raise rates probably next week, presumably by 75 basis points. So the Fed is pretty committed to taming the inflation beast, even if it risks a recession. At least that's what it's saying. And I think the real question will be maybe 6 or 12 months down the road. It looks like inflation is peaking, although you wouldn't tell by looking at the CPI report. But you look at the TIPS market, you look at what's happened to price of crude oil, copper, even used car prices. They've all started to come down, right? So it's pretty likely that the inflation numbers will start to get a lot better in the coming months. But the ultimate question is, how far will they improve, right? The Fed's target is 2% for the PCE, which is about 2.5 for the CPI. So let's say 2.5 is the Fed's comfort zone. If we go from 9 only down to 4, let's say, which is not a prediction, but just for the sake of argument, and the economy at that point has entered a recession, let's say 6 to 12 months from now, what's the Fed going to do? Is it going to be able to aggressively ease the way it has in the past? Or will the fact that inflation is still kind of proving to be sticky, limit what the Fed can do? And I think that's an important question for the financial markets, because that's what we call the Fed put, right? As soon as things go south, the Fed's in there cutting rates, presumably back to zero and doing quantitative easing. That ship seems to have sailed, and so it's a question of how accommodative the Fed could be in the future, and what that means for the economy. Does that mean we're going to run at a subpar pace? And what does that mean for stores of value, whether it's gold or real estate or Bitcoin? So all questions without an answer, but to me that's going to be the next major chapter. Is the economy slows, inflation is slowing, but it's not slowing fast enough, and how does that change the math for the Fed?
And that's really the question for assets like Bitcoin is, we know the story over the long term. We know, supply and demand models, and we see this, asymptotic like adoption. But in the short term, you can't deny that the macro environment has sort of caused pretty much all assets to trade as risk on or risk off, and Bitcoin and crypto sit in the bucket that is furthest out the risk curve, at least currently. And correlation-wise, you're at all-time high correlations to the S&P, to the NASDAQ. So, lastly, maybe we'll leave it at this, is in the short to intermediate term, is there maybe a setup here, whether it's tighten too much and pivot, or become a little bit more dovish, where that works to the benefit of Bitcoin, of these assets that are seen as the most risk on in the short to intermediate term?
Yeah, I think as we've seen over the past 6 months or so, Bitcoin and the crypto space in general is not immune to the forces of leverage and deleveraging, right? So we're seeing that play out, and if the leverage has left the space, and I don't know that it has, but we're certainly seeing enough headlines to suggest that maybe we're seeing the worst of that, then I think Bitcoin will have settled in kind of a new valuation range where the investors, people who are interested, will feel more comfortable, taking a stab at it, because the space is not caught up in this deleveraging storm. And like you said, all assets have gone down, even bonds have gone down, right? So no asset class really has been immune, and so that's which is what has made the last 6 months of this bear market pretty unusual, certainly over the last several decades. So again, coming back to valuation, if the demand curve through the lens of mobile phone adoption or internet adoption or some other adoption curve historically suggests that Bitcoin should be at 50 or 100 or whatever the number is, and it's at 20, if enough other sophisticated investors start running the kind of models that we have done, that gets them a sense of what the fair value or what the future projected value is. It won't be a DCF approach, but it'll be a network growth approach. And if there's a sense that the deleveraging storm has passed, then Bitcoin will do what it has done several other times, right, over the past decade or so. It will just rebuild and get closer to ultimately what its fair value should be, because that's how efficient markets work, that's how the fundamentals work. And as long as that adoption curve continues to grow, we don't know at what exact slope it will, but as long as it continues to grow, then the value should improve over time, because all those curves go up and to the right. It's just they go there at different speeds. So I do feel that after this, big winter that we've had for the digital asset space, that the rebuilding will start just like it did in 18 and 19 and 14 and 15. And there'll probably be another leveraging storm a few years from now, but we'll deal with that a few years from now.
Yeah, well, one thing's for sure. Crypto markets will not get boring, right?
That's for sure.
No matter what happens, really. All right, I think that just about does it for us. Thank you, Urian, for joining. Thank you, listeners, for tuning into this edition of The Value Exchange. Urian, where can listeners find more of your research?
So I'm on Twitter @TimmerFidelity.
And I'm on Twitter as well, a lot less followers, @J_newwriter, and check out FidelityDigitalAssets.com to see more of our digital asset research. Thanks for joining.